Okay, thank you, Anna. I'd like to start by just expressing views that have already been said by others here. FedListens is really just an innovative outreach effort, and this is really a remarkable conference. I'd like to thank Vice Chair Clarida and the committee for including a session on financial stability as part of this review of the monetary policy strategic framework. Financial stability is an important issue when considering effectiveness of possible monetary policy strategies, lower for longer, quantitative easing, since they will affect financial conditions and financial vulnerabilities, and therefore risks to output, growth, jobs, and price stability. We're extremely fortunate to have our experts on this panel, all who have made significant contributions, in some cases for decades, to this literature on the financial sector and growth and monetary policy. First, we have a paper by Anil Kashyap and Casper Ziegart. And Anil, you all know, is a professor at the University of Chicago. He currently is an external member of the Bank of England's Financial Policy Committee. He has various affiliations with, consultant with the Chicago Fed at times. Casper is a senior policy advisor to the Secretariat in the Bank of England's Financial Policy Committee. Our discussant today is Mark Gertler, a professor at NYU, a research associate at the NBER, advisory board of the New York Fed, has written many papers and made substantial contributions to this literature, including papers with Vice Chair Clarida and former Chairman Ben Bernanke. So without further, I'll let Anil get us started.
All right, thanks. I especially want to thank Vice Chairman Clarida and Ellen Mead, who I shudder to think how much work she put into this, but Ellen deserves all of our thanks. I don't know where she is. She's probably running around. There she is. Okay. Well, thank you, Ellen. So I think I should start by saying now for something completely different. Okay, so we wrote a short paper. I can describe it on one slide, and I'm going to do that. I could just sit down then, but I'll go through the argument in a bit more detail. I'll say one thing on communication policy. You guys want to communicate clearly. You cannot say business casual and then show up in suits and ties. Totally blew your credibility. And you notice everybody from the private sector that has nothing to do with the central bank took your plain words at what it meant. They weren't wearing ties. Okay, so here we go. Here's our argument. So kind of deja vu, the first step is there's now an account of the global financial crisis that I'll go through pretty quickly that's pretty standard. But there's also a narrative about what the risks that we're facing now are. And the narrative I'm going to give you for now is going to come from the Fed's own financial stability review. Both of them point to two shared problems, which was activities outside of the traditional banking system and excessive debt buildups. Lars had to leave, but he threw in a sentence when he said, well, and I'd rather macroprudential tends to debt buildups. I'd love to know how he's going to do that. I mean, he can assume a can opener, but the thing is, we don't have a way of really dealing with that, neither the FSOC nor the Fed. And the next step in the argument is to say, well, okay, maybe that would all be okay if financial stability problems couldn't complicate monetary policy, and if the conduct of monetary policy couldn't contribute to financial stability risks. But that's pretty doubtful too, and it's not fancy econometrics or exotic models that would point to that, and I'll try to elaborate on why that's so. So if you take those two propositions that I expect most of you would accept, you're in a pickle because you've got these risks that are there, you've got nobody who can do anything about them, and you know that if the threats actually manifest, it's going to create trouble. And so the argument in the paper is, A, we should come clean on this, and B, it's on Congress to take the first step. Now, it's strongly in the Fed's interest to get out in front of this and concede this point and hopefully try to get something done about it. But that's the argument. This is pretty simple and pretty straightforward, and I think each step in the argument isn't very controversial. So we're going to suggest a technical commission that we think could perhaps help on this, but that's where I'm headed. So let me give you the narrative of what we think of now as kind of a conventional view of the financial crisis. There were kind of two legs: problems to do with funding and leverage in the financial sector, particularly outside of the traditional core banking sector. Here's some numbers that just show you how extreme the leverage was for the broker-dealers. Here's some numbers just to remind you about the insane run-up in short-term financing that we saw through a variety of channels. Chairman Bernanke talked often that there were runs, but they just weren't the ones we were used to seeing. But, I mean, the numbers are kind of stunning. So those are two accounts of what went wrong. And then the third one is a body of work that has emerged since the crisis. My colleagues, Mian and Sufi, have done a lot of this, pointing to the problems with excessive levels of debt, especially in the kind of tail of the distribution, where we talk about people with, let's say, loan-to-income ratios of more than 4 or 4.5, or debt service ratios beyond 40%. So those numbers crept up as well. So coming into the crisis, we had these two problems. We had this flighty, fragile structure of the shadow banking sector, and we had a bunch of over-indebted households. Now, what could have been done? Well, with hindsight, the two things you would have liked to do, I'll take them in reverse order on the slide, is you would have wanted to do something about the buildup in household debt. But there's nobody in the United States regulatory apparatus that has any authority to do anything about that. So even if you told us this was going to replay, there's nothing you could do to really stop it. Fortunately, right now, household debt doesn't seem to be out of control, but that would have been the first thing. And then you would have liked to have done something about the capital requirements and liquidity requirements, particularly for the broker-dealers. I mean, we should remember it was Lehman, Bear, AIG. It wasn't the core banks that were at the center of the shock, but the FSOC really isn't well designed to do very much about that. They can issue explain or comply recommendations, but there's no mechanism inside the U.S. regulatory structure that says you can expand the perimeter when something migrates outside of the part that's well regulated. And so we don't really have a way as the FSOC to be able to do anything about that. And the Fed can't really do much about that either. So that's not a very reassuring state of affairs. So we could go next to saying, okay, well, maybe that's a historical exercise. We don't want to fight the last war. Let us look at what's going on now. Okay, so the Fed has started issuing this financial stability report. I'm guessing most of the people that aren't inside the Federal Reserve System haven't paid a great deal of attention to it. It's a pretty high quality report. Lots of data, lots of thoughtful analysis. I think a reasonable comprehensive grouping of the risks that the economy could face. But when you cut down and start reading about what risks they're identifying now, there's two things that stand out. One of them is elevated asset valuations. We've cherry-picked here two indicators, just the term premium on 10-year bonds, safe bonds, and that's before all the events of the last 10 days, so that term premium would be even more negative now, or the compression between spreads on corporate bonds and treasury securities of the same maturity. Okay, so those are pretty compressed. I'll show you some numbers at the end that would suggest that maybe that's not a great indicator for the medium-term safety of the financial system. And then the second risk that's identified in the FSR is this explosion of corporate indebtedness. Some people would say, well, you push down on the leverage inside the financial system. Maybe the fact that it goes to the corporate system corporate side isn't completely unexpected. Maybe those two are related, but we've got a lot more corporate debt. The third bar chart over there of the leveraged loans is something that a lot of people in this room have heard about. Those things sit outside of the banking sector. So what's important about that second chart is just look where the corporate debt is ballooning, and then look to the extent you're going to find it by inspecting the banks. The banks might be, fortress and very safe, but that won't matter if the debt is dispersed. Okay, so now let's redo our exercise and say, okay, suppose we were convinced that this was a big enough problem to threaten financial stability now. The FSR as it's constituted doesn't make that judgment, but let's suppose things get to the point where everybody could agree that that was a risk. What would you do? Well, we don't really have anybody that can build resilience against potential falls in asset prices. The Fed can do a stress test on the core of the banking system to make sure that part can bear the losses. But if the losses show up elsewhere, it's back to explain or comply. And if the entities that are holding the securities are outside of the banking system, there's not much you can do, neither the FSOC nor the Fed. How about the limit, the buildup in corporate debt? The slide says the controversy around the interagency guidance on leverage lending. I think a better word would have been debacle. Here was a case where they spotted a problem, issued guidance, the courts have struck it down, and we've seen that stuff is growing like a weed and nobody can do anything about it. Now, it doesn't really matter whether these two problems are going to be the ones that will trigger the next crisis. I'm willing to speculate we will have some bout of financial instability in the future, and it's kind of interesting that the two parts of the system that the regulatory apparatus isn't well positioned to do anything about is where the risks are already showing up. You might think that that's kind of a feature, that regulatory arbitrage is a strong, powerful force that's going to keep showing up. Now, that's the first step in the argument. The second step in the argument is, well, maybe we don't need to worry about this. Maybe if there is a financial crisis, it somehow won't complicate the Fed's life. I think I've counted 4 times people have pointed out the distance between the level of rates now and the effective lower bound being inadequate. So I'm not going to review this. I've just quoted a bunch of numbers here. Quarter of the people in the room have made this point. So the idea that if there's a bout of financial instability, it's going to hamper the ability to deliver price stability shouldn't be very controversial. Okay, so that's one side of the coin. The second side is whether or not just business as usual monetary policy might be creating vulnerabilities with regard to financial stability. Okay, now here's the one piece of kind of novel empirical evidence that we've got in the paper, and this builds on work that Nellie has done with Tobias Adrian and others. So the graph there is the following thought exercise. We run regressions all the time of GDP on different variables, let's say the term premium. Instead of predicting the mean of the variable, suppose you tried to predict the entire distribution. So you could predict the 90th percentile of the distribution. Here we've tried to predict the 10th percentile. So that means if you ran history 100 times, 10 times or fewer, you would expect to see the outrun of GDP be that solid line in the graph. Now, what that tells you, and this is from data across, I think, 16 countries over 30 years, so it's not just US data, it's a lot of different countries because you don't get to see the 10th percentile of GDP very often, so you need to use panel stuff. What you see is when term premium compressed for the first few years, that's generally good news for the worst case kind of recession. But then notice when you get to be 3 or 4 years out, actually the odds of a very bad outcome get higher. Okay, and there's a whole bunch of these financial stability indicators that look like that they give you comfort in the short run, but then when you start looking later out, the tail risk looks worse. And, QE, when it was first introduced, was partly an attempt to try to crush term premia. So this isn't a bug, this is a feature of doing this. And if we're going to hit the zero lower bound or the effective lower bound and use this in the future, which way is this going to go? Okay, so then that gets me to the last point, which is we've got this regulatory, what we call underlap. I mean, there's gaps. And that leads us to think that there's kind of three options here. First, hope. I usually say hope isn't a plan, but we could hope that Congress reviews the design and boundaries and authorities of the FSOC. Second, you could ask Congress to give the Fed an explicit financial stability mandate and the tools to act on that. That was something that was actively debated at the time of Dodd-Frank. Didn't happen then, who knows. Third, and maybe this is third best, fourth best, you could just decide, based on the evidence I've shown you, that to deliver price stability, you have to have financial stability, and then you could try to pull all of these considerations into using the interest rate and monetary tools to deal with them. That'll be not very effective. Certainly, you'd much rather have the macro-pru tools, and maybe it's not even going to work. I mean, I don't think trying to lean against the wind is going to help you build up or reduce the buildups of debt, for instance. So we think that as a result of this, it's time to kind of use the occasion of the 10th anniversary of Dodd-Frank to turn the argument that's very active in the media on its head. There's been a lot of discussion saying, oh, it's 10 years on since Dodd-Frank. Clearly there was excesses. Let's dial some of it back. And that's a completely reasonable thing to do. But it's also true that Dodd-Frank was written before we had much of the research that now informs our view of the crisis. There was no discussion of excessive debt buildups in 2009 when Dodd-Frank was being written. So maybe it's not unreasonable that that wasn't contemplated as a financial stability threat. But it is now. And so why not say, okay, we're going to dial back some of the stuff that Dodd-Frank didn't touch, and in its place, we'd like to go ahead and reconsider what the macro-pru toolkit has to be. I think that there's a pretty strong argument for that. Our suggestion is to copy the model that was used for the panel or the commission that Catherine Abraham chaired. This is a long way from monetary policy, so maybe you don't know about this, but believe it or not, since President Trump has been in office and since the last Congress was in session, there was a commission formed to study evidence-based policymaking, and there the plain words are what it means, evidence-based policymaking. Let's look at what the evidence says. They passed a bunch of recommendations. It made it through Congress. The president signed a bunch of legislation. So I think we shouldn't be so cynical as to say that politics prevents us from trying to make these points and trying to get a technical discussion of what we could be doing on the record or in the public domain. I think it's very strongly in the Fed's interest to be leading on this. Otherwise, you're going to get a tweet blaming you. And I think we have to do this. And so let me close by just making an analogy. I think the last time somebody from Booth was in an event like this worrying about financial stability was Ragu in Jackson Hole. Now, he saw stuff that was really difficult for most of us to follow. I didn't understand that argument the first time he made it to me. It turned out to be right, turned out to be disastrous that we didn't, act a little bit ahead of time. This stuff is far simpler to understand. You don't have to be a PhD in economics who's an expert to understand the concerns that I've just laid out. If something bad happens, regardless of it's the risks now, but if something like this happens in the next 5 or 7 years, the answer was, oh, it was politically too difficult, is not going to reassure the public. We will take a beating as a profession of economists, as central bankers, as regulators, as experts. We will get crushed. And so we need to do something. And I think we can start by trying to tell Congress, you need to have a commission that's focused on this. You don't have to open up the entire Federal Reserve Act and reconsider soup to nuts. You can worry about this problem that's very clear, or you can reconsider what the FSOC can do. Again, you don't have to reconsider everything. You can just say, where is there regulatory underlap? Let's see if there's something that really needs to be done. And I think if you reflect on this for a while, you'll see that we can't be quiet about this. It's better off to go down fighting and say, we think this is a problem. We want to try to get something done. And doing it now in peacetime when there's not a recession, when we're not in crisis, is exactly the time, because it'll take a while to get this through. So there we have it. Thank you.
Okay, first of all, thanks a lot for including me in this program, and also thanks for asking me to discuss this very interesting and provocative paper. Now, the authors make three main points, and I basically agree with them. The first is that the Fed should have a central role in maintaining financial stability. The second is that in terms of reducing the likelihood of a crisis, the best approach is macroprudential policy and not monetary policy. Third, the existing macroprudential toolkit may not be adequate. Some tools do not exist. Some are ambiguous in terms of how they would work, or at least these tools are not battle tested. However, there is a qualification. The regulatory and supervision advances have been considerable since Dodd-Frank, and the banking system now is much safer than it was in 07, 08, and it means the likelihood of that kind of meltdown at least is remote in the near term. And after listening to Anil, there's a fourth point that I agree with, and that's always pay attention to Raghu Rajan. Okay, so given the authors offer a very careful discussion of macroprudential policy, I thought I would step back and look at the big picture of how you integrate financial stability into the monetary policy framework. And in my view, financial stability is not a separate objective. The objective is the dual mandate, output at full capacity with price stability. And think of financial stability as an intermediate target. It's something that's critical for achieving output and price stability goals. Now, this is not a new idea. The lender of last resort was a key motive for the founding of the Fed. The pivotal event was the panic of 1907. At that point, J.P. Morgan and some other private investors injected liquidity into the system to save the banking system. It was realized we don't want to rely on a private system, so let's create a national lender of last resort, and hence the Fed. Now, what's different today? Well, financial markets have evolved. Liquidity provision and systemic risks extend beyond commercial banking. The expansion and contraction of the shadow banking sector the last decade was a good example of this. So as a result, lender of last resort policies extend beyond the commercial banking sector. And also because financial markets are more complex, the broader measures are necessary to ensure, broader and more complex measures are necessary to ensure financial stability. Okay. So to talk more formally how to think about financial factors, I think it's best to briefly review the standard framework with frictionless markets, and I'll do so in the simple three-equation model. We can think of the output gap depending upon inversely upon the gap between the real interest rate and the neutral rate, plus some extra factors x. Inflation depends upon the output gap and some extra factors z. And then importantly, the Fed adjusts the interest rate, Rn, in response to deviations of inflation from target and deviations of the output gap from target. And if inflation's at target and the output gap is at target, the interest rate's at the neutral rate. Now, 2 points here. First of all, the neutral rate not only provides a benchmark for policy, it's a constraint on policy. So if inflation's at target, the output gap is 0, the Fed can't simultaneously deviate the real rate from the neutral rate. The other point is that R star is a moving target. It depends upon growth, saving, preferences for safety, and so on, and we know the neutral rate has been moving downwards. Now, this simple model, I think, provides a pretty good description of policy. So in the top graph, the red line is the neutral rate as constructed by Laubach and Williams. The blue line is the actual real rate, the actually ex ante real rate. In the bottom panel, the blue line is the output gap. The red line is year-over-year core inflation. The blue dotted line is where the output gap is 0, and it's where inflation is at 2%. And there have been 3 episodes where the real rate has been pushed below the neutral rate. And in every case, the output gap has been negative. Output has been below potential output in the 3 cases. And in 2 of the cases, inflation has been below the 2% target. Now, the first place where discussions of financial stability come in is it's suggested that in early 2000, the central bank should have raised nominal rates to fight off the housing boom. That is, deviate from focusing on the recovery to curtail the housing boom. And it's also been suggested in the past few years, perhaps the Fed should deviate from the recovery objective to forestall the corporate debt boom. And what's clear from the pictures is there would have been a cost to doing this in terms of slowing the recovery. And in fact, it would likely require rather big increase in interest rates to do anything about the financial imbalances, so the cost would have been sharp. So more generally, should we adjust for financial imbalances? Should the Fed react to offset excess credit growth or asset price growth? And here, as I've just shown, there's a trade-off. In addition to reducing the current values in output and inflation, there's a danger of loss in credibility as it becomes more slower to meet the target. Also, clearly there are benefits from reducing imbalances, but the difficulty is identifying these imbalances. Credit booms can be good as well as bad. Asset price booms can be good as well as bad. It's just difficult to tell. And also, we don't have any experience or any idea what it's going to take in terms of interest rate adjustments to slow down an imbalance. And the final point I would make is it's not even clear that increasing rates reduces financial vulnerability. That will reduce asset values and weaken balance sheets. Okay? All right, so with that in mind, how do we think about adjusting the framework? Well, the first thing to keep in mind is that in a financial crisis, the cost of credit becomes elevated. So I'm going to write the required return or cost of capital, RK, as the sum of the real rate plus a term I'll call the excess return, or chi. Now, even in normal times, there's going to be an excess return. It's likely due to risk factors. But what happens in a crisis is the excess returns become elevated because what happens? If financial distress raises borrowing rates relative to lending rates, it can be due to distress on the part of the borrower, or it can be due to distress on the part of the lender. So now what's a financial crisis? A financial crisis is a rise in this excess return that feeds into the cost of capital and pushes output down. So what are the challenges for the central bank? Well, we can divide this between ex post, that is acting to offset the impact in the increase in excess returns, and also ex ante, taking measures to reduce the likelihood of excess returns. Now, just to be a bit more precise, if we look at the recent crisis, one way to capture the elevated cost of credit is to look at credit spreads. And here I've portrayed 3. The BAA bond spread, the 30-year mortgage spread is the red, and the black line is the commercial paper spread. And you see in each case they become elevated, and they reach a peak at the vertical line, which is the Lehman bankruptcy. And in terms of these credit spreads feeding into the cost of capital, we have a story for the contraction in real activity, which really reached a peak at that time. So you can think of the objective of the Fed policy to reduce these spreads, and also from an ex ante point of view, reduce the likelihood that they increase. So let me start with ex post interventions. First, you can use a conventional interest rate. And what does this imply? This implies you want to compensate for the increase in spreads, the effect on the cost of capital. So there should be an extra downward adjustment in nominal interest rates. And we saw the Fed do something exactly like this in 2008. The funds rate was reduced far more than a simple Taylor rule would predict, and that was offsetting the increased cost of credit. Now, unconventional, sorry I made these slides before Chairman Powell gave his talk yesterday, so we could call these lender of last resort policies. These are policies to directly reduce excess returns, and we can go through a set of examples. The LIBOR spread went up. We had the term auction facility put downward pressure on those spreads. Commercial paper spread, commercial paper funding facility that also pushed spreads down. And then finally, mortgage spreads and term premia. And as I'll show, at least in the case of mortgage spreads, the LSAPs were effective in compressing returns and pushing spreads back down. Okay, let me say go into a little bit more depth about LSAPs. It was discussed in the last session, but here I want to talk about this from the perspective of a lender of last resort policy, a crisis prevention policy. And in my view, you think of LSAPs as central bank intermediation. What's a central bank doing? It's funding long-term securities by issuing short-term debt, in this case, interest-bearing reserves. And what do government bond purchases do? They reduce excess term premia that have been elevated due to the crisis. The AMBS purchases reduce excess mortgage spreads, that is, the spreads that have been elevated due to the crisis. And the key point here is that LSAPs are most effective when private intermediation is under stress. When these intermediaries, like these broker-dealers, were under stress, what happened is the value of the securities in their portfolios declined. The Fed could come in, buy them, and bid them up. So in my view, LSAPs are a useful crisis tool. I'm going to argue they have a somewhat limited role in normal times. Okay, and let me just show you some data. Okay, the top line is the behavior of mortgage spreads over the different QE episodes. The bottom line is, bottom panel is the behavior of term premia. And the first line, I think you can see, is in fact, QE1 was a resounding success. And I should say, I totally agree with John Taylor. You would like to see this in the raw data. We've had event studies, but you'd like to see the effect of QE in the raw data. And if you look at QE, you see mortgage spreads crept up, QE1 comes along, the vertical line is the announcement date, and you see a steady decline in mortgage spreads. And they stay down for a while. They go up a little bit after QE2, but then QE3 comes in and you see mortgage spreads go back down again. So to me, at least from the raw data, this policy looks quite successful. It's more difficult to see with term premia. You do see term premia elevated as we go into the crisis, and it does look like QE1 has an effect on term premia. Elsewhere, it's hard to see a persistent effect of government bond purchases. And one thing, I think that's consistent with the theory, because QE is more effective the more illiquid markets are. And AMBS markets are going to be less liquid than government bond markets. Now, a couple of other points from this slide. QE, government bond purchases end in 2016. Term premia have been steadily going down since. Now, what does this suggest to me? That there's other factors going on explaining low term premia. I don't think we can blame the Fed for this one. The other factor, note early on in the sample in 2006, term premia are also low. And I have a hunch, I could be wrong, that this is partly why you're getting a forecasting effect of the term premia on the lower tail of output. And the story you're telling may be reasonable, but in 2006, 2007, there were also other things going on, like high household debt, high leverage of investment banks, so it'd be useful to sort this out. Okay. All right. Now, let me talk briefly about macro pru, because I think this is covered really well in the paper, and I don't have a whole lot to add. There are three interdependent spheres of potential financial vulnerability. The first, the commercial banking sector. The second, the non-banks just outside the regulatory perimeter, that is the shadow banks. And the third is the non-financial borrowers. And I think the general consensus is that macro pru has reduced risks in the commercial banking sectors, higher capital, liquidity requirements. We have the stress test, countercyclical capital buffers. This has all been positive. And the argument of this paper is that there's less progress with 2 and 3. And the problem is the limited authority of FSOC, and also the tools are limited to comply or explain, and we really don't understand yet how effective these tools are going to be. Though I should point out, as Nellie has done and worked with Rosella Edge, this is not this is not unusual. Most financial stability committees have this kind of power. The question is whether we need more for the U.S. Okay, and I agree with the things Neil said about and Casper said about setting up a commission and so on. I have nothing against that. But the question is, what do we do in the interim before the commission gets going? Now, my view is that the first objective of macro-PRU should be to avoid disasters. Okay, and avoiding disasters, I think, means protecting the core banking system. And in work I've done, and Neil works that Neil's done, and Ben has also done, the banking collapse was critical to the seriousness of the Great Depression, the Great Recession. The last recession would have looked more like 1991 or 2001, 2002 if it wasn't for the banking collapse. So strong capitalization of the banking sector is a good first step. Well-capitalized banks can't perfectly offset limits to the macro-PRU toolkit, but it can help avoid disasters. But also critical is to have leverage over the systemically relevant financial institutions on the regulatory perimeter. That is, think Lehman and AIG. And the reason the Great Recession got so bad, I think, was because of the Lehman failure along with AIG that led to the collapse of the investment banking sector and the stress on the commercial banking sector. So what does this mean? I think the Fed has to seriously be ready to use its power over systemically relevant institutions. It has to be ready to move quickly. And even though such an institution does not likely exist today, there's a good chance that it's going to grow up in the future. And the bottom line is that while the threats may not currently exist, history suggests that regulatory migration. And it's inevitable that the next crisis, even though it may not happen in the next couple of years, it's going to involve a new generation of shadow banks. Okay, thank you.
So we have time for questions for the authors, and I'm going to start over there and just move across. So I see Bill Dudley. We have a number of people over there. Krishna, and let me take 3 there and just go across. And if you could, there are a lot of questions, so if you could keep your questions short, and we'll take a couple and take 3 and then let them respond. Thank you.
Bill Dudley, Princeton University. So I agree with everything that was said up there. I think addressing this ex ante rather than waiting for the bad outcome and then saying, oh, we should have done that. It's not a really great approach. So what's the biggest argument against doing this? I think the biggest argument against doing this that you'll probably hear is, well, the Fed, if they tried to push for this, just wouldn't be successful. They would fail. People would look at it as the Fed is crying wolf or the Fed is trying to accumulate more power, and so it wouldn't be successful. I don't think that's a good excuse to not pursue this. As I see it, this is a multi-period game. If you don't identify the issues ex ante and push, then ex post, when the crisis comes, the Fed's going to be viewed as failed. I think the Fed owns financial stability whether they want to or not, and the Fed would lose credibility. If you try and push for a commission and try to push this forward, I think there's 2 potential scenarios. One, bad things don't happen, but you're pretty happy with that outcome. And the second thing is that bad things happen. In other words, you don't get what you want and you fail. I still think the Fed's credibility would go up, and the Fed wouldn't be blamed as much for that outcome. So I think pushing helps build the Fed's credibility over time, even if they don't necessarily succeed in the first round for this. So I think you shouldn't talk yourself out of this on the basis that you might not be successful. You'll still get some benefit of pushing for this, even if the Fed actually can't get this commission up and running. Thank you.
Krishna?
Thank you. I just wanted to invite the authors to connect this discussion with the discussion we've been having in other sessions about potential alternative monetary policy strategies. What are the financial stability issues potentially associated with moving to some form of inflation averaging regime, whether that's by way of an ex-ante targeting above 2% in good times, or whether it's some variant of a make-up strategy.
I'm going to take one more back there. Thank you.
I'm going to use some slight inside information about Anil, whose office is 15 feet from mine. In 2008, I asked you, Anil, what I couldn't understand why the savings and loan crisis wasn't a systemic event when it looked like the losses in the savings and loan crisis were, on the order of magnitude of some of the losses in subprime. And the conventional wisdom was there were strong institutions that could fill the hole when the institutions outside the regulatory framework started to collapse. They could be filled. And so the one thing that was different about this last crisis from the previous one was everybody kind of held the same stuff. That makes me wonder, in the interim, before there is agreement that the Fed would have the ability to go after or regulate the non-commercial banks, isn't the optimal thing, sort of as Mark said, to make sure that there is a core of strong bank institutions that could actually step in and you might never see a systemic risk event? And then the second question that I would have is, even if you granted the regulatory authority to confront excess leverage in some part of the economy, isn't one of the big lessons that it's extremely hard to do that, maybe personally or institutionally, to get up and say, you guys are the problem, you must reduce the leverage in that sector, look at how dangerous it is. In a way, couldn't we be doing that now? If the Fed chair were truly believed that leverage is too high, corporate debt is too high, could they not get up and make the public case for putting pressure on that through other institutions?
Would you like to
Yep.
respond?
Maybe let me start with some of your comments. Yes, I mean, obviously we're absolutely not arguing that all of the reduction in term premium is due to quantitative easing. There have been clear kind of secular declines, as is easy to see in the data. I think one thing that we do observe in the data, and that seems to drive this kind of non-monotonic relationship between GDP at risk and term premium, is that what you typically see is that if term premium fall sharply, eventually they'll bounce back up again. And that's the thing that drives the negative financial stability consequences. At least that's kind of just looking at the raw data suggests that may be part of the story. I think we absolutely agree that having a well-regulated, extremely resilient core financial system or core banking system is extremely useful and takes you a long way. And arguably the very reason why some of the shadow banking entities are not regulated is because we expect trouble in those entities to cause less damage than in traditional banks. I think at the same time there are a number of institutions. I mean, we've seen the money market mutual funds that are not necessarily individually systemic, but that are not fully regulated and can cause a lot of trouble in a crisis. So, maybe you don't want to just stop at regulating the commercial banks and bank holding companies very sensibly, but you also want to go there if you can.
Okay. So on Austin's thing, I actually don't think the Fed can just stand up and say we're worried about leverage and expect it to work. They even tried to give guidance to slow it down, and that was beaten back because there's money to be made. So I don't think giving a speech would help. I do think the stress tests are the big win post-financial crisis, and the stress tests you can stress leverage lending and you can do all that. We showed that chart that just indicates the losses won't start out in the banking system, and we think the banking system is less interconnected now than it was, and all that's good, but I still am kind of with Mark that there'll be some morphing of all of this, and it'll show up in a way that we don't really understand until it's probably too late. So I think it would be good to have somebody with this authority. I will tell you, I'm not speaking as a Bank of England official, and maybe Don will want to add to this. It concentrates your mind when you're on a financial stability committee and you know that the headline will be, these are the 9 people that screwed up, okay? We don't have that right now. If something goes wrong, there'll be a bunch of fingerprint pointing. The textbook on the next crisis won't have the analog of 1 or 2 people that slipped up at their job, at least in the US context. I can guarantee you, if there's a problem in the UK financial system, the FPC will own that problem. And that makes a big, big difference. So the combination of owning the problem and actually having the tools makes you, look around the corner and try to worry about that stuff. And I think it would be good to have that. A commission would have to debate these questions. On Krishna's question, I think it's very hard to know. I mean, one of the things that, at least I had to miss part of yesterday because I was teaching, so I didn't hear every session, but people that are practitioners in financial markets will talk about risk on, risk off stuff. And there are potentially elements of forward guidance that generate a little bit of that. And so to the extent that that's part of your toolkit, I don't think that has to do so much with makeup strategies or inflation averaging or any of that. You'd want to be aware of it. So I think there's a weak connection there, but I don't think that's a first order problem.
Can I just pick up on something Austin says? An anecdote from the I was on the advisory committee at the New York Fed in the summer of 2008 when Tim Geithner was in charge, and I sort of naively asked, well, do the banks have enough capital? And Tim's response was, well, on their own they do, but not if they have to absorb the assets of the investment banks, and that's proved to be relatively prescient. So you'd kind of like, ideally, you'd like the banks just out the regulatory sphere. You'd like them to be safe. But if they're not safe, you kind of like the commercial banks to be able to compensate.
Let me go to this middle section. Stan Fisher, Andreas Leonard, Sylvan.
Thanks. You've identified a problem which has been clear from the beginning of Dodd-Frank. And the question, what I was told when I asked people who knew these things, because I wasn't here when the system was being set up, what was the problem? And the problem, I was told, was in the heads of the congressional committees supervising different groups of financial institutions, none of whom was willing to give up their authority, which meant that the FSOC is a particularly weak organization. So that's one of the things that needs to get done. And then you'll face the question of what exactly is this commission supposed to do? Is it going to be asked to describe a regulatory system for the whole financial system, which is an ambitious task, but it's probably what is needed. And here I was expecting, I don't know if Don Cohen is here, I was expecting Don to put in his speech for the structure of the British lender of last resort system, in which they have taken the trouble to figure out what's going to rescue people who are not covered by the existing lender of last resort. We went backwards on that, and we decided we didn't want a lender of last resort because of moral hazard. I find moral hazard arguments particularly painful because they seem to me to be illogical. Here is the statement of moral hazard. These guys, these 10,000, I don't know how many people they are, these 20,000 guys have created a massive crisis. Well, we shouldn't help them because we've got to teach them a lesson. Now, who the heck is them in this one? It's certainly not the people who created this crisis. They first of all came out of it probably with more money than they went in. Secondly, they'll be dead by the time the next crisis shows up, and they probably will have forgotten about it. So I don't see what you gain by creating a recession to teach those people a lesson. We're teaching ourselves a lesson. But my view on the moral crisis argument, if you get yourself to the point where you are going to punish, I thought of this originally in the Korean crisis, 35 million people in order to teach 5,000 bankers a lesson, you're nuts. That was what we were told to do by many people who didn't want the fund to lend to Korea. But I think the big question for you is going to be, I would recommend that if you're going to recommend this commission, which I strongly support, is that you have a pretty clear idea before you recommend it what are the changes that need to be made and exactly how it can be arranged and what the bureaucracy of that will be. And it's clear that there was a failure in setting up the controlling bureaucracy in Dodd-Frank. Thank you.
Thank you, Stan. Andreas?
Thank you. So let me start by thanking the panelists for like a really interesting paper, Anil and Casper, and a really interesting discussion, Mark. So I think it is worth clarifying that the system is undoubtedly safer. Many of the things that you pointed to as being problems sort of in the original narrative, have been fixed. Lehman Brothers failed. Many of the other investment banks, eventually migrated inside what you call the commercial banking system, inside bank holding companies, where they're subject to, prudential regulation of kind of the standard type. And of course, Casper, as I'm sure you know, the money market mutual fund problems in the United States have been addressed. So 2 questions. First, Anil, as a member of the FPC, the FPC, as I understand it, does have some of these macro-prudential tools that could constrain borrowing by households and businesses if it so chose. And since you seem to be advocating the provision of those sorts of tools in the United States, what experience you've had with those, and the sort of considerations in the deployment of those tools. Second question is how to think about the GDP at risk literature, to which you've made a contribution here, and which several others have worked on. I mean, it does seem like there's I don't want to say a Lucas critique, but you're sort of saying that, well, historically these things have been kind of correlated under very different institutional circumstances, and now we're living in this world of much higher capital ratios, a much smaller shadow banking system, a much less leveraged non-financial sector, and yet we somehow still expect the same set of tail risks to evolve. Thank you.
I can take one more question and then we respond. And if we could keep the questions just a little, please be brief because there's a number of people still. Sylvain?
Sylvain Leduc, San Francisco Fed. I was wondering if you could talk a little bit about the governance issue of macroprudential tools. On the one hand, it makes a lot of sense to have it embedded in the central bank, given that you understand the macroeconomy, you produce the financial stability report, but many other countries choose different arrangements where they're embedded with the government, the Minister of Finance. That's the way, for instance, it is in Canada, where the Minister of Finance have responsibility over LTV ratios, debt service ratios. And so I was wondering, given your experience on the FPC, if you could comment on this a little bit.
Would you like to respond?
All right, so I'm glad to hear Stan was supportive of this and Bill was supportive of this. We're going to have a petition outside. And it's a good point that we should think more carefully about the remit. We'd welcome input from the Federal Reserve staff and others about how something like this could move forward. So that's a serious point. We need to do it. In terms of the FPC's tools, Don will correct me if I'm wrong. I mean, the kind of thing that the UK has done, for instance, in the housing space, is to say the flow of new loans that are being originated by every lender, not just the banks, every lender, can be no more than 15% of those can have high loan to income ratios. So if your loan to income is above 4.5, only 15% of the flow can be of that type. So you're not rationing any particular borrower. If you look, the number of people getting loan to incomes of 4, so bunching right below the thing has happened. That's a feature, not a bug. There are op-eds that you can find in newspapers saying it's a good thing these guys are worrying about this. Now that may be UK specific because housing has been kind of at the scene of the crime in many of the UK downturns. So I think there hasn't been that kind of pushback. So yeah, I think you can do it. I think your point on GDP at risk and the external validity of the historical stuff is a serious issue and one that lots of people are trying to think. And Nellie is continuing to think about this. I don't know. It kind of takes a model to beat a model, so that's where I think that is. And then on the governance question, I don't think it would have to sit inside the central bank. I think somebody's got to own the risks and have the authority to do something about it. So if you wanted to set it up outside the central bank, but have enough central bank representation, I think that could work. One thing that hasn't happened, at least in the UK, is there's never any finger pointing amongst the Monetary Policy Committee and the FPC because too many of the members overlap. So they can't say, oh, I woke up on the wrong side of the bed. I'm on the FPC side today. And so that just doesn't happen. At the FSOC, there's obviously silos and turf, but it doesn't have to be inside the central bank. I think maybe it makes sense, but the central bank's got to have a big input into all of this, since you're probably still going to have the checkbook at death when the lender of last resort shows up. The central bank's going to be there, so they've got to play a role. But these things are manageable. We're for better or worse running lots of natural experiments across other countries because there is no best practice right now, and you could see a couple of the papers Nellie's written cataloging these differences. So there's no one way to do it, but the one way not to do it is to not give whoever is notionally in charge the tools they need to do their job. And that's the complaint in this paper.
So 2 questions here. Ben Friedman and Don Cohen, please. Thanks.
I think the paper and the discussion were excellent, and I would hope we move forward with something like that. But in the meanwhile, I think there are 2 things that are much less ambitious that are worth keeping in mind. One, to address and Stan is unfortunately gone, but to address the issue of moral hazard without inflicting the penalty on millions of people that Stan mentioned, many people have proposed what's called Chapter 14 bankruptcy as a way of addressing bank bailouts, and it's a way of doing this, which actually puts at risk the people that Stan was describing in a way in which they are not at risk currently when the central bank does a bailout. So for people who are not familiar with the Chapter 14 suggestion, I would recommend that. Second, there's something that the Federal Reserve can do on its own wicket, and it just combines this session and the last one, and it goes back to what Mark was saying, but thinking, using Mark's vocabulary, thinking in terms of doing something ex ante rather than ex post. Mark's charts were very good about showing how these spreads widened out and talked about that and then narrowed and so forth. And Mark talked about it as what do we do to get spreads down once we're in a mess, but there are periods when the idea would be to get spreads widened out, not narrowed down. That's Mark's ex ante policy. Several people throughout these 2 days have mentioned the state of play in 2003, 4, 5, 6, when everybody understood that there was an excess in the mortgage lending market. People thought we were building 2 million houses a year. That was clearly too many. Some people called for the Federal Reserve to increase interest rates. In the language of the day, I can't remember whether this was Ben or Alan, the idea was no, we shouldn't do that because raising short-term interest rates is a blunt instrument, was the vocabulary, was a blunt instrument with which to attack or to offset an excess in one particular market or sector. But today, the Federal Reserve has a portfolio of, what is it, $1.5 trillion worth of mortgage-backed securities, which in a replay of 2003, 4, 5, 6, the Federal Reserve could sell those into the market to widen out spreads. That would be a perfect example, I think, of what Mark meant by ex-ante policy. Now, one of the implications of that is that you shouldn't sell these because you want to be able, you shouldn't sell them now, you should wait until you want to sell them. But there are things that you could do creatively that are not that are well short of the more ambitious plan that Anil and Casper are suggesting.
Don Cohn, Brookings, and FPC. So pick up on a couple of themes. Mark's point about financial stability and the dual mandate, absolutely. And connecting it to this conference, I would emphasize even more the nearness of the zero lower bound, effective lower bound, means that a financial system that amplifies shocks is going to get you to the effective lower bound more frequently. And the stronger the financial system, the less often the Federal Reserve will be stuck with this thing. So one way to motivate the Commission, and I think the Fed should be taking the lead here and make the argument that strengthening the system helps the dual mandate and helps to preserve the dual mandate. The second point would be the Fed does control the bank holding company, banking system, and I think making the capital there, not letting up on the counter-cyclicality of the stress tests. So that's the key to making sure the banking system doesn't amplify a shock. So the counter-cyclical elements of the stress test, the scenario, the pre-funding of dividends and buybacks, those are important. And if you're going to let up on that at all, you need to substitute a counter-cyclical capital buffer. So it's in your interest and the country's interest to make sure that the banks are there, are super strong, and can fill in, as Mark said, if something bad happens to the other folks. So keep that stress test tough and counter-cyclical. And the third point is on the housing. So I think one reason that we didn't get blowback in the UK on the housing stuff was it was put in as insurance. So when the 15% was put in, the banks were at 13 or 14%, and it was sold as we're trying to prevent a problem from happening, and it's not a hard ceiling, it's this 15%. And there are other elements to the housing thing too, but there was very broad acceptance of preventing a problem. And that brings me to housing in the US. So we've talked a lot about outside the banking system, but the housing market in the US has been the cause of lots of problems. Obviously 2008, but even the early 90s, et cetera. And there are a lot of government agencies that have some authority here, FHFA, PA, FHA, CFPB, all these agencies. And I think it would be good for the government or for the Fed to try and organize these folks to think about the macroprudential financial stability implications of the things they're putting in. I know that right now the households are fine, et cetera, but this is where problems build up, and I think the Fed could take the lead in thinking about any erosion of standards in housing lending that might produce problems in the future.
We have time for, Ellen, do we have time for a couple more? Yeah, okay. Torsten, is that Torsten back there? And then Julia? Is there anything over here?
Jan Hatzius, Goldman Sachs. I had a question about the impact of low-term premia on the 10th percentile. And I was wondering whether that's buildup of risks or potentially greater proximity to the effective lower bound, since low-term premia mean low interest rates. And I was wondering also whether you could look at just long-term interest rates instead of term premia, and whether you get the same kind of relationship.
Julia, and then Lou.
Julia Coronado, Macro Policy Perspective. So I just want to build on something that Don said and kind of circle back to tying this all together to the broader conference. I mean, I think the commission and is a great idea. I have no issues with that. But I thought the whole GDP at risk concept was to tie together the various mandates. And so it's not just the extreme outcomes that we're worried about, but even just the cyclical outcomes that we're worried about. So for example, in the current context, we're talking about leveraged lending and that it is large and corporate debt is high. And at a minimum, most of the FOMC seems to conclude that it will be an accelerant in the next cycle. Okay, so an accelerant in a loss function to me tells me I'm going to lose more on inflation in the next downturn because of this leverage now. And so I have to balance that on how easy you policymakers have to balance that, and how easy should you make policy? What is the associated further buildup in leverage, and at what cost will it come on inflation? Which, since we're all talking about how to get inflation higher, what will be the cost to inflation in the next downturn from this leveraged lending buildup? I think that's the question, and that's, to me, the beauty of the GDP at risk model, is that it's not just about the financial stability and the extreme circumstances, but making monetary policy through the cycle, and therefore it's very much in the purview of the Fed, absolutely above and beyond any commission, very much central. So I'd like to hear your thoughts, and I'd like to hear Nellie's thoughts on that too, since you were part of that literature.
Great. And Lou? And then.
Just very quickly, it seems to me that what Anil and Casper have identified is a legislative problem, and it is going to require a legislative solution. I'm sure this is not a point for the Fed policymakers. They get it that they're going to have to deal with Congress, but for the experts in the room, I would just ask you to think about how do experts interact with Congress in a way that's constructive. I was involved with the OFR, it's a different thing, but one of the reasons OFR underperformed was it never got a full vetting in Congress, and they never had a base of support in Congress. I think actually of the model of the National Monetary Commission and the role that played in the creation of the Federal Reserve, that's like a long time ago, but I think you need to, if this is going to be successful, it has to be successful with Congress. And it's important, if you're going to think about a group of experts being involved in it, to keep that in mind.
Would you like to respond to?
So I'm probably the least qualified person in the room to comment on US politics, so I'm going to pick out the more technical questions. On the question of whether there's a case for bringing spreads artificially up in the ex-ante scenario, I think we very much agree with that. Don't have strong views on whether that's via monetary policy or not. But one thing that is interesting to see when you go through the case studies is that actually, if you just focused on making the core financial system resilient, the impact that would have had on lending spreads would not have been nearly high enough in order to lean against the real economy debt buildup. And if that's something that you care about in its own right because of some aggregate demand externality in the downturn, then you probably want to do something on top of just making sure that financial institutions are resilient, and the sort of loan-to-income limits that Anil mentioned earlier are a way of essentially doing that. You don't impose a price, but obviously there is a shadow price to the constraint that we're imposing. On the whether for our GDP at risk framework, on whether this is driven by term premium or interest rates. So we need to look at that in a bit more detail. Kind of the initial results are not as clear-cut for just looking at long-term interest rates. Also, if you look at the sample, then actually a lot of the action is driven by a period where we weren't close to the zero lower bound. So it seems to be a genuine term premium effect, which kind of makes sense if you think about the term premium as the risk, the compensation that investors receive for a little bit of interest rate risk around the predicted forecasted path, then obviously if you compress that term premium, that can raise some risks. Last point on the GDP at risk framework and whether that is kind of in a way combining monetary policy and financial stability objectives already. I think I'm not sure I fully agree with that in the sense that if you think about, say, the 5th percentile of GDP at risk, this is clearly in the tail, and that 5th percentile may never materialize over a business cycle. So if you're a monetary policy maker and you focus on the central expectation, it's not immediately obvious to me that you would put a ton of weight on that. I think more generally, our point is that you can get yourself comfortable that the financial stability objective is implicit in the monetary policy objective, but you still want to have the extra tools in order to deliver those various things.
Okay. So I'm being told we need to put a stop at this. I also just want to mention on the GDP at risk, it's not just me. There's a bunch of New York Fed economists here, and I think Nina's in the room, and some others who've been doing quite a bit of work on this area, and it's something that I think needs to be developed, but we'll get there. So I'd like to thank these panelists for the papers and the discussions and the questions. Thank you very much.
Okay, I've been asked to say just a few words in conclusion. I know we have flights and things, so I'll be brief. So I want to thank you all again for participating in this FedListens event, and I think you'll agree that we've shared an invigorating and thought-provoking 2 days. To stage an event like this requires the energy, efforts, and talents of dozens of people, maybe even several dozens of people, and I won't have time to name them all, but I would be remiss if I didn't mention a couple of folks here. First and foremost, in the interest of transparency, this conference is Chair Powell's idea. It's his priority and his vision, and all that I and my colleagues have been doing is to execute on that vision. So that's first and foremost. Second, I'd like to thank Charlie Evans and Anna Paulson, who have been gracious and flexible and nimble in the planning of this conference. When I first called Charlie up in October, I said maybe 60 people, maybe 50 or 60. And then a month later, 90. Then a couple months later, 120. We're at 175. And if we'd had Wrigley Field available, we probably could have filled that. So thank you both for that. I'd also like to thank my colleagues on the Communications Subcommittee, Lael Brainerd, Rob Kaplan, Eric Rosengren. This very much had been a committee effort, in particular to Eric, because it was his Brookings paper with colleagues that provided a lot of our thinking on this. Also, Michelle Smith and Dave Skidmore at the board, who originally came up with the FedListens idea. And then finally, last but not least, Ellen Mead, who has tirelessly worked 5, 6, 7, even 8 days a week for the last 8 months to pull this off. So a big round of applause for all those, but especially Alan. So on that note, the FedListens event is adjourned, and we look forward to interacting in coming months. Thank you very much.